Welcome back to the deep dive. Today, we are setting the stage for one of the most compelling geopolitical balancing acts of the modern era.
Hmm.
We're witnessing a high-stakes economic confrontation where a massive world power, we're talking about India, is attempting to preserve its strategic autonomy
Right.
and maintain its explosive economic growth, all while facing intense, focused pressure from the United States regarding its energy policy.
And we should be clear, this isn't just about Russian oil imports, that's the flashpoint, but it's much, much bigger than that.
Exactly. We are talking about crippling tariffs, the logistics of global evasion, and a multi-layered financial defense strategy involving local currencies, complex logistics, and, well, an unexpected, almost forgotten monetary metal.
Silver. That's absolutely right. The source material we've synthesized for this deep dive.
Yeah.
And it's a collection of geopolitical briefings, trade analyses, and central bank commentary. It paints a picture not just of, passive resistance to external pressure. It's a picture of profound financial and logistical innovation. We're looking directly at the execution of India's strategic pivot, often referred to within certain financial circles as their secret gold game, its aggressive use of non-dollar trade mechanisms, and this highly unique domestic proposal regarding the potential financial backing of silver.
So our mission today is explicitly to unpack this incredibly complex, high-stakes strategy. It's not enough for you to just know that there is a conflict between Washington and New Delhi over energy.
Right, the headlines tell you that much.
We need to understand the practical, the operational, and the financial deployment used to bypass the world's dominant U.S.-controlled financial infrastructure. We want to know how they are doing it and what the ultimate goal is.
Precisely. The goal here is to grasp the practical sort of street-level execution of strategic autonomy when the reserve currency of the world, the U.S. dollar, is actively being used as a tool of foreign policy enforcement. We have to look past the headlines and see how nations are adapting to the reality that, dollar access can be weaponized at any moment.
Okay, so let's unpack this. How does a nation balance its colossal energy needs, support massive necessary economic growth, and fiercely protect its geopolitical independence when the financial hammer of sanctions is hanging right over its head?
Well, that's the multi-trillion-dollar question, isn't it?
That is where we start, with the pressure cooker of U.S.-India trade tensions.
We begin with the core strain in the relationship, which, has been escalating pretty sharply since the 2022 invasion of Ukraine. The central issue, without any ambiguity, is India's continued, robust, and growing purchase of heavily discounted Russian oil.
And this was a major break from the Western consensus.
A huge break. While Western nations, led by the U.S., implemented these sweeping sanctions designed to cut off Russia's energy revenues, India just looked at the situation differently.
How so?
Well, they were faced with a massive domestic energy shortfall and really high global prices. So from their perspective, they saw an unprecedented economic opportunity that they were strategically positioned to seize. It was a national interest calculation, pure and simple.
And what we see in the sources is that the U.S. reaction was not subtle at all. Under the Trump administration, the punitive measures were quite harsh. Can you detail the kind of economic pain that was applied?
Certainly. This wasn't minor diplomatic friction. It was an explicit use of hard economic leverage. The sources detail that punitive measures included tariffs imposed directly on Indian exports flowing into the U.S. market.
And these weren't small tariffs.
Not at all. At one point, these tariffs reached an astounding 50% on certain goods.
50%.
50%. I mean, that's a serious, almost crippling economic punishment aimed squarely at making certain Indian exports completely uncompetitive in the U.S.
To put that figure in context for you, a 50% tariff isn't just a fee, it's a massive disincentive. It signals extreme displeasure.
It's a blockade, effectively.
Right. This wasn't merely about trade protectionism. These tariffs were clearly described in the source material as explicit retaliation for India's continued decision to purchase Russian crude and refine it.
And this is where the complexity truly starts, because these energy politics, they very quickly infected other major diplomatic efforts.
It never stays in one box.
Never. What makes this especially complex is how these tariffs stalled and complicated the larger U.S.-India trade deal that has been under negotiation, particularly since early 2025. I mean, you simply cannot negotiate a massive bilateral agreement intended to deepen trust and cooperation when one partner is simultaneously levying these kinds of tariffs against the other.
Especially over what India sees as a fundamental policy disagreement, a sovereign right, like energy sourcing.
Exactly. It creates an atmosphere of distrust, which, as the source material suggests, demonstrates that for Washington, maintaining the integrity of the sanctions architecture against Russia is, at least in the short term, a higher priority than advancing the bilateral trade relationship with a key Indo-Pacific partner like India.
So they prioritized the sanctions tool over the partnership development tool.
It did, precisely. Now, given that intense pressure, the critical question becomes, how did India publicly and diplomatically defend its position? Because they didn't quietly comply or backtrack.
No, they stood their ground.
They stood their ground on the core principle of strategic autonomy.
Their defense has been consistent and, frankly, diplomatically aggressive. It emphasizes two non-negotiable points: energy security and national interest. India is a subcontinent of 1.4 billion people with immense, rapidly growing energy requirements needed to fuel their massive economic expansion. So they make the point that sourcing the cheapest available oil on the global market is not just, prudent fiscal management.
It's essential.
It is absolutely essential for managing domestic inflation and protecting the living standards of their population.
And the sources give us a fantastic illustration of this defiant stance, captured perfectly by their External Affairs Minister, S. Jaishankar. His statement became a kind of mantra of profound independence.
It really did.
It was a signal to the world, and specifically to Western capitals, that India will not compromise its core policies based solely on external diktat. He essentially said, if you don't like it, don't buy it.
That phrase is a masterpiece of diplomatic assertiveness. It just encapsulates the entire spirit of strategic autonomy.
It really does.
They are signaling, we are a sovereign nation with our own needs, and we refuse to yield policy positions that are domestically critical simply because they displease a foreign power. They frame these purchases not as supporting Russia, but as essential diversification of their energy sources.
But this firm stance, naturally, it drew some heavy geopolitical critique. You mentioned Treasury Chief Scott Bessent, who publicly accused India of profiteering from discounted Russian oil.
That's a loaded term.
Very loaded. It implies a cynical, opportunistic motive, and it shifts the focus from national need to purely financial gain.
That's a powerful narrative tool, isn't it? Painting India as taking advantage of a global conflict. But India has a potent and I think even a necessary counterargument: the issue of hypocrisy.
And this comes up again and again in their public statements. New Delhi views this criticism as deeply hypocritical, given the history and, importantly, the parallel consumption of Russian energy by many Western nations.
Even after the sanctions.
Absolutely. Even after the initial sanctions were implemented, there were carve-outs, long lead times, and you saw continued consumption of Russian gas and LNG by European countries. To Indian policymakers, all the moralizing just sounded hollow.
Right. So India's argument is basically, why is my necessity viewed as profiting, while your necessity is viewed as a strategic exception?
Exactly. It highlights a double standard that New Delhi uses to justify its own actions.
So we have the U.S. applying pressure via crushing tariffs and sanctions on Russian firms, and India responding with diplomatic defiance and a firm commitment to energy security. That tension sets the stage for the practical, logistical, and financial workarounds they deployed to actually keep that discounted oil flowing.
And this is where we move from the diplomatic arena, the realm of words and policy statements, to the logistical and financial battlefield. This is the practical, deep dive part of the operation.
Let's get into it.
The shift in India's energy consumption has been truly transformative. Before 2022, Russian oil imports accounted for barely 1% of India's total imports. I mean, it was essentially a rounding error.
Right, almost nothing.
By 2025, that figure had skyrocketed to roughly 35–40% of their total crude imports.
35 to 40%. That's not just a strategic decision, it's a dependency now.
It is. And it's entirely driven by the significant heavy discounts Russia was offering, discounts made necessary because Russia had been deliberately cut off from its traditional lucrative European markets.
And this rapid, dramatic shift immediately ran into the operational and financial wall of U.S. and G7 sanctions.
It hit a brick wall. The sanctions specifically targeted major Russian oil firms like Rosneft and Lukoil, and crucially, they targeted the logistical backbone.
What do you mean by that?
I mean, Western insurance, Western shipping registries, and access to the global financial clearing system. So this meant that the traditional safe methods of importing, insuring, and paying for the oil became either illegal or just prohibitively risky for major Indian refiners and banks.
Okay, so this is where the logistical game really begins. This is where the sources detail truly fascinating evasion tactics.
It is. The restrictions forced the Indian buyers and the Russian suppliers to get incredibly creative. They had to effectively build parallel supply chains and parallel financial systems from scratch.
So what did that look like?
Well, we absolutely see the emergence of highly sophisticated operational workarounds. The concept of the shadow fleet is perhaps the most visible and widely discussed element of this.
The shadow fleet, it still sounds like something from a thriller novel, but it's a genuine economic infrastructure. What are the specific mechanisms they use to evade detection and maintain insurance coverage?
It's an entire infrastructure of evasion built on opacity. So first, they rely heavily on flags of convenience, registering these older vessels in nations with notoriously lax maritime enforcement or regulatory oversight.
So the ships are harder to track and regulate.
Much harder. Second, they often engage in ship-to-ship transfers, or STS, far offshore, sometimes in the high seas or in neutral waters.
How does that work?
A sanctioned Russian tanker transfers its cargo to a non-sanctioned clean tanker registered under a third-party flag. This effectively washes the origin of the crude before it even reaches the Indian port.
So the paper trail is intentionally fractured. That makes it difficult for Western enforcement agencies to pinpoint the ultimate origin of the crude when it arrives in India.
Exactly. And it's not just the ships. Indian refiners had to source this oil through complex, multi-layered networks of intermediaries.
Middlemen.
Right, often newly established trading houses in Dubai, Singapore, or Turkey. These intermediaries act as buffers. Some refiners temporarily halted direct Russian oil imports to manage regulatory risk and avoid secondary factions.
But the oil kept coming.
Yes, the source material confirms that overall flows remained robust because they simply routed the oil through these intermediaries and the shadow fleet. The system adapted by adding layers of opacity and complexity to manage risk while keeping the crude flowing.
Okay, so now we have the physical oil moving. The next and arguably more important challenge is payment. Because if you're trying to avoid Western geopolitical control, using the US dollar defeats the entire purpose.
It does. The dollar system is the primary enforcement mechanism for those sanctions.
Well, what did they do?
That's where we pivot to the financial bypass, the crucial move to non-dollar settlements. We are seeing the increased use of non-USD trade arrangements, specifically rupee-ruble deals or other local currency settlements for the oil. This reduces vulnerability to Western financial control, but the practical execution is fraught with challenges.
Let's dedicate some time to that. Specifically, the major challenge inherent in the rupee-ruble system, the trade imbalance problem. This is a technical detail that often gets overlooked in high-level discussions.
It's so important, though. It is the Achilles heel of this entire strategy. So when India imports massive amounts of oil from Russia, which they are, reaching nearly 40% of their needs, they pay for it in Indian rupees.
Okay.
Russia, however, exports far less back to India than the value of the oil they sell. This creates a colossal trade imbalance.
And what happens then?
Russia accumulates massive stockpiles of Indian rupees in special accounts called Vostro accounts in Indian banks.
So Russia has literally billions of rupees sitting in New Delhi bank accounts, but they can't easily spend them. Why can't they just use those rupees to buy other things?
Because the Indian rupee is not a fully convertible currency on the global market. And Russia simply doesn't import enough Indian goods and services to absorb the massive surplus.
So they can't exchange it for dollars or euros easily, and they don't buy enough Indian stuff to use it up?
Exactly. They can use the rupees to buy things like tea, pharmaceuticals, or equipment from India, but the scale of those purchases is nowhere near the scale of the oil sales. The sources confirm this pile-up problem is serious. It's a major liquidity trap for Russia, and it limits the overall effectiveness and sustainability of the rupee-ruble system.
So the workaround provides sanctions immunity, but introduces a major fiscal headache for the recipient country. This isn't a flawless system. It's a necessary compromise.
Exactly. The purpose is still manifold. It reduces direct vulnerability to the U.S. Treasury, and it lessens dependence on the U.S. financial system. But the rupee pileup shows that building independent financial rails for critical trade is messy, challenging, and requires constant diplomatic negotiation to figure out how to repatriate or spend those stranded funds.
So they are using this tactic because they must, but it comes at a cost.
A significant cost.
So India is simultaneously deploying a shadow fleet for the physical goods and non-dollar, often imperfect settlements for the money. It's a comprehensive strategy for logistical and financial independence from the West, driven by necessity.
It is, and this move toward non-dollar settlements is a symptom of a much larger structural trend that provides the perfect pivot to our next section, the global phenomenon of de-dollarization.
Right.
India's choices are not isolated. They are part of a much bigger story.
Here's where it gets really interesting. India's immediate dilemma over Russian oil serves as a vivid case study for a massive structural shift happening across the globe. We need to talk about why the rest of the world, specifically the Global South and major energy producers, is joining this push away from the dollar.
Absolutely. India's actions are perfectly logical within the context of three accelerating global trends that are eroding global dollar dominance. The first reason is the one we just experienced firsthand, the weaponization of the dollar itself.
Explain that weaponization for the listener. I mean, for decades, the dollar has been synonymous with stability and global reliability. Now, for many governments, it's seen as a liability, a high-risk asset.
It is now viewed as a systemic political risk. The U.S. government uses its control over the dollar's clearing mechanisms like correspondent banking and the SWIFT messaging system as an explicit, potent foreign policy tool.
Right.
So when the U.S. can, at the flick of a switch, freeze a nation's dollar reserves held in foreign accounts, or block them from accessing the global financial clearing system for trade, it effectively turns the currency into a massive choke point for global commerce.
And this isn't theoretical. The sources point out that the seizure and freezing of hundreds of billions of dollars in Russian central bank assets was the moment that truly spooked central bankers globally.
That was the wake-up call.
Especially for those in countries with, let's say, contentious relationships with Washington.
That event demonstrated that reserves held in dollars, while liquid, are fundamentally politically contingent. The sources note that over 30 countries, Russia, Iran, Venezuela, and increasingly others, have faced direct sanctions, leading them all to seek alternatives. They want to avoid being held hostage by U.S. political decisions, regardless of whether those decisions are justified or not.
So the lesson learned globally is that if you hold dollar reserves, you surrender a piece of your financial sovereignty.
You absolutely do.
If the U.S. government can flip a switch and essentially take your money or block your ability to trade critical goods, any rational sovereign nation is going to frantically look for a different power source.
Precisely. And this systemic risk drives the second major reason for de-dollarization: the consolidation and rise of multilateral trade blocs and alternative financial systems. We are talking specifically about the expansion of the BRICS Plus group.
That expansion is a geopolitical game changer that we must dwell on. BRICS Plus now includes not just Brazil, Russia, India, China, and South Africa.
The original five.
But critically, Saudi Arabia, the UAE, Iran, Ethiopia, and Egypt.
That is a crucial list of members, and the geopolitical implications are enormous. You are adding key, indispensable global energy producers, Saudi Arabia, Iran, UAE, to a bloc that already includes massive consumer economies like China and India.
And when you put them all together,
Collectively, BRICS Plus now controls a massive share of global energy resources and a majority of the world's population.
and with this consolidated power, the push to settle trade in non-dollar mechanisms moves from, a fringe idea to a viable alternative.
Absolutely. With the inclusion of major Middle Eastern oil powers, these countries are increasingly empowered to settle trade using non-dollar mechanisms. We're seeing real-world tests now. Increased use of local currencies, the Chinese yuan, the Emirati dirham, the rupee, the ruble to clear transactions, specifically for oil and gas.
So this isn't just talk anymore.
No, it's a slow but steady restructuring of commodity trade finance outside of the dollar's traditional domain.
And this shift fundamentally alters the leverage equation. If a critical mass of the world's most essential commodity energy is being traded outside the dollar system, the U.S. financial system's ability to enforce sanctions is dramatically curtailed.
It is. And the third, and perhaps most foundational reason driving this trend, it stems from internal U.S. fiscal issues. The deepening concerns over U.S. fiscal stability.
The debt.
The debt. The U.S. government debt has recently crossed the staggering mark of $35 trillion.
$34 trillion. That's a number so large it almost loses meaning for most people. What's the implication for foreign holders of U.S. assets?
The implication is risk and uncertainty. That level of debt, combined with dollar inflation and what foreign observers view as perpetual money printing by the Federal Reserve, raises serious long-term concerns about the dollar's reliability as the global store of value.
Right.
Foreign central banks look at that trajectory, and they calculate the odds of the U.S. inflating away the value of its debt. They see a long-term risk to their savings.
So the dollar is simultaneously weaponized and viewed as fiscally unstable. It's sort of the worst of both worlds for a central bank.
Exactly.
They can't trust the currency, and they can't trust the government that issues it not to seize it or dilute its value through inflation.
That dangerous combination political risk plus financial risk is the single engine driving what we call the central bank gold rush. It provides the only reliable defense against these dual threats.
And this is why the action moves to the ultimate hard asset, gold. Our sources confirm this is a massive synchronized move.
It's huge. Central banks worldwide have responded to these trends by buying record amounts of gold in 2022 through 2024, the highest volume seen in over 70 years, since 1950.
And who are the main players here?
This is a coordinated strategic accumulation designed to restructure national balance sheets. It's not just a handful of usual suspects. The list of major buyers is long and politically diverse. It includes China, Russia, India, Turkey, Kazakhstan, the UAE, and Saudi Arabia.
All the big BRICS plus players, essentially.
Yeah. Pretty much. They are all actively and quietly shifting their sovereign wealth away from politically and fiscally risky paper assets and into physical metal.
So why gold? We need to really synthesize this for the listener. What does gold offer now that cash dollars or euros do not?
Okay, it comes down to four critical factors that address every geopolitical pressure point we've discussed. First and foremost, sovereignty.
Explain that.
Gold is physically sovereign. It sits in a vault, often on home soil, and unlike digital dollar reserves held in New York and London, gold cannot be frozen by the U.S. Treasury, the Bank of England, or SWIFT bans.
So it's immune to the weaponization.
It is completely immune. It gives true, absolute control back to the state.
It's the ultimate hard asset defense against political risk and potential financial conflict.
Secondly, it acts as a phenomenal hedge and store of value. It serves as an anti-inflation shield and essential monetary insurance against both a weakening dollar and rising concerns over sovereign U.S. debt. When global confidence in paper currency wobbles, gold holds its intrinsic value.
Okay, that makes sense. The third reason connects directly back to the BRICS plus expansion and the need to trade outside the dollar system.
Right, and it specifically addresses the flaws we discussed, like that rupee-ruble trade imbalance.
How so?
That's its role as a neutral settlement asset. As more trade pivots away from the dollar shifting to yuan, dirham, or rupee-ruble gold is being prepared as the fallback asset to settle those residual imbalances.
So if a country ends up with too much of another country's currency,
They can cash it in for gold.
Mm.
If China buys oil from Saudi Arabia in yuan, but Saudi Arabia doesn't want to hold a huge stockpile of yuan, they can demand settlement in a universally accepted neutral asset. Gold fills that void perfectly. It prepares central banks for a genuine multi-currency trade world where paper liabilities are backed by something universally accepted.
and finally, a more straightforward reason.
Yes, central banks are buying it to simply strengthen their financial foundations against internal market volatility. Having substantial gold reserves stabilizes their own national currency. It strengthens their central bank balance sheets and increases overall investor confidence in their economy.
So this central bank gold rush is not about speculation.
Not at all. It is about national strategic security and building resilience into their financial architecture.
Okay, so we've established that India is part of this massive global gold rush, accumulating sovereign reserves to manage external risks. But now we get to the most unique aspect of India's overall financial strategy, which goes beyond the standard international playbook, their dual metal strategy involving silver.
This is where India truly differentiates itself and shows an astonishingly creative approach to building financial resilience from the ground up.
How so?
They are simultaneously participating in the global gold accumulation trend, gold for the Reserve Bank of India, which is the central bank's ultimate Tier 1 international reserve defense, while considering a highly unique domestic financial strategy involving silver to bolster the local economy. This is about building bottom-up resilience.
We need to dive into the rationale for silver, because internationally, silver is primarily viewed as an industrial commodity. Why is silver being actively considered as a backing mechanism for financial institutions within India's domestic economy?
The sources highlight three overlapping and powerful reasons, and they're all rooted in India's unique cultural and economic context. The first is a deeply ingrained historical and cultural affinity.
It's more than just a metal there.
Oh, much more. India was, for centuries, the world's largest consumer and accumulator of silver. It isn't just a commodity there, it's deeply integrated into their savings culture.
And we are talking about massive, virtually untraceable quantities held privately outside the formal banking system, right?
Massive. Silver is accumulated by hundreds of millions of households, particularly in rural communities, and by enormous temple trusts. It often serves as the primary form of savings and wealth storage for large portions of the population that don't traditionally access formal banking or stock markets.
So that cultural foundation means that when the government proposes a silver-backed financial instrument, it leverages an existing, immense, and decentralized pool of trusted wealth.
It does. They see a massive, untapped domestic savings pool in silver that they can potentially monetize and integrate into the formal economy.
Right. What's the second reason?
The second reason is pure economics and logistics. Abundance versus scarcity relative to India's domestic output. India produces very little gold domestically.
So it all has to be imported.
All of it. That means gold must be imported at high cost, adding to the current account deficit, and it exposes them to global price volatility. Gold is scarce for India, making it unsuitable for mass-scale domestic use.
But silver is different.
Silver is different. It's imported in massive volumes. India is often the largest importer globally, and it's relatively cheap compared to gold, making it abundant for domestic use.
So the strategic reasoning is pretty clear.
Crystal clear.
Hmm.
Gold is expensive, volatile, and must be held centrally by the RBI for ultimate international reserve defense. Silver, conversely, is abundant, trusted domestically, and provides a scalable monetary metal suitable for smaller, local, decentralized financial institutions.
That distinction is key. You use the rare, globally recognized asset for the nation's war chest and the abundant, locally trusted asset for decentralized domestic financial support.
And that leads us to the concrete proposals, the tangible policy ideas for how silver will actually be used to strengthen the domestic financial system. This moves beyond theory and into actionable policy.
What are the specific silver-backed instruments being proposed in the source material?
We see three main interconnected avenues for application. First, developing silver-backed bonds. These would be targeted specifically at microfinance institutions and rural banks. This leverages the cultural trust in silver to create viable, low-risk investment vehicles at the local level, offering a tangible alternative to pure paper currency savings.
So that immediately links the vast local savings pool and local metal preferences directly to the formal, regulated banking system.
Exactly. It provides much-needed liquidity and stability to the bottom tier of the financial pyramid.
And the second proposal.
The second crucial proposal involves balance sheet support for non-bank financial companies, or NBFCs. Now, these are vital to India's economy. They are critical for providing credit, lending, and liquidity outside the major commercial banks, especially in sectors that traditional banks often avoid.
And why are NBFCs uniquely suited for this?
NBFCs operate with different regulatory capital requirements, and they often face liquidity crunches. Allowing them to use verifiable silver holdings as collateral, as a recognized Tier 2 asset on their balance sheets, would provide significant stable balance sheet support.
So it makes them more resilient.
It enhances their ability to lend reliably and serves as a natural stabilizer when the economy faces stress. It essentially provides a physical asset floor for a crucial part of the credit ecosystem.
And finally, strengthening the public banking structure itself, the base layer of the economy.
Yes, the third proposal is to use silver vault reserves alongside gold, but specifically leveraging silver to strengthen institutions that serve the heart of India's economy: cooperative banks, rural regional banks, and agricultural credit institutions.
The backbone of the rural economy.
Absolutely. Providing them with a physical, stable, domestically accepted asset reserve strengthens their ability to absorb localized economic shocks, droughts, or sudden withdrawal events.
So if we look at this holistically, gold is the impenetrable shield against global sanctions and dollar risk used by the RBI. And silver is the localized foundation, supporting the credit and stability of the economy's base layer. It's a remarkable, deeply pragmatic dual strategy.
It is. And the strategic narrative connects all the dots back to sanctions avoidance. India is not just buying discounted oil. It is fundamentally restructuring its financial resilience to protect itself from external financial coercion.
Whether that comes from high tariffs or a sudden cutoff from SWIFT.
Exactly.
So that's the key question. How does the silver proposal, which is purely domestic, relate to avoiding external sanctions like those imposed over Russian oil?
The connection is the buffer capacity. By strengthening internal monetary and metal reserves, gold for the central reserves, silver for decentralized banks and local finance, India ensures that if external sanctions were ramped up,
Like, for example, an attempt to severely penalize Indian banks dealing in non-dollar oil trade.
Precisely. If that were to happen, the domestic financial structure does not collapse into a credit freeze.
They build shock absorption capacity. So if the central government is battling external pressure using gold and local currency deals, the MBFCs and rural banks are supported by silver, preventing internal contagion and maintaining credit flow.
Precisely. They are systematically reducing their entire financial system's dependence and vulnerability to the U.S. financial tools, enhancing their strategic autonomy, not just diplomatically on the world stage, but deeply and structurally within their domestic economy. This is a quiet, profound declaration of financial independence.
This has been an incredibly detailed deep dive into global finance and sovereign strategy. Let's synthesize the key takeaways for you, the listener.
Good idea.
We've seen India execute a diplomatic balancing act, maintaining its energy security despite extreme U.S. pressure and crippling tariffs.
We also spent time detailing the logistical mastery required for this, ranging from the complex utilization of shadow fleets and intermediaries, which are essential to keep Russian oil flowing,
Right.
to the crucial shift toward non-dollar payments like rupee-ruble systems to financially bypass Western infrastructure. Crucially, we noted the inherent systemic challenge of those local currency pileups, showing that these workarounds are challenging but necessary.
And most importantly, we've analyzed the fundamental, unique shift in India's financial strategy, the embrace of strategic metal reserves. We linked to India's gold accumulation to the broader global de-dollarization trend driven by the dollar's weaponization and U.S. fiscal instability, and then analyzed the highly unique, internally focused use of silver to bolster local financial institutions and stability, particularly the essential NBFCs and rural credit systems.
The relevance to you, the informed listener, is clear. This deep dive shows that geopolitical pressure does not just lead to diplomatic friction or symbolic gestures. It is actively fueling profound, costly, and complex innovation in global trade and finance. Countries are being pushed to redefine resilience not through military strength alone, but through financial engineering and strategic commodity accumulation outside of the Western financial sphere.
It's a compelling look at the practical, expensive, and necessary application of sovereignty in the 21st century. The game is no longer played just in treasuries and central banks. It's played on the high seas and in the vaults of cooperative banks.
And it leaves us with a final provocative thought. Considering India's unique dual metal strategy, gold for the center, silver for the local economy, and the rising U.S. fiscal debt concerns that are accelerating the global gold rush, what might be the next inevitable step beyond de-dollarization? Could this return to hard assets, metals, and local currency trade accelerate a global trend toward genuinely commodity-backed trade systems, perhaps even regional ones, that permanently displace the dollar centrality in the next decade, making the gold rush a prelude to a new financial architecture?
Something for you to mull over as the global financial landscape continues its dramatic shift.